Well, hello everyone. Welcome to Getting Started with Options. My name is Barbara Armstrong. I'm a coach with Schwab and delighted that so many of you have chosen to join us live here today. I want to thank those of you who have been engaged in the chat already and, tend to show up 15 minutes or so early to just greet one another and help bring this class to life. So thank you for that. So to Jay and Wiley and Austin and Backroad Bob and Kevin and people tuning in from all over the country, Jeremy and Sandeep and Tony and the rest of the gang, thank you all for being here. We also have Cameron May with us in the chat. He's a friend and a fellow coach. He understands this strategy inside and out. So if you have any questions, please don't hesitate to type them into the chat. In my opinion, the only bad question is one that you don't have the courage to ask, because chances are, if you have that question, there are probably a dozen other people attending live with us that have that question, and probably another dozen or two dozen more who will be watching this in the archives that will have the same question as well. Now, if you are watching the recording and you have a question, you can just type it into the comments down below. And I do look at those on a daily basis, so I'll get back to you pretty quickly. Okay, so today, what are we talking about? Today, we're talking about long call verticals. And if you're saying, I thought this was a beginner class where you spoke in English, I do. And it is. And a long call vertical is a modestly bullish trading strategy, I would say. So it's a strategy that one might tend to use when the market is going up, when a stock is going up, to try and take advantage of that type of movement. We are in week 9 of a 12-week series. So that's kind of exciting too. And you may say, week 9, this is my first time here. I'm just checking it out for the very first time. And that's okay. I'm not assuming that you've watched weeks 1 through 8, but I will put a link into the entire series. So if you want to go back and start with one, and instead of binging Netflix or Hulu or whatever other streaming services out there, you want to do some binge learning, this might be a place that you may want to spend a bit of time. Also, I invite you to follow Cameron and I in the land of X, formerly known as Twitter. My handle at Barb Armstrong CS. Cameron's is at Cameron May CS. I will admit that we are posting content on a daily basis that we think you will find helpful. Obviously, there are some ne'er-do-wells out there who kind of think the same thing, because I have had not one, not two, I have had 6 imposters in the last week and a half. And one of the things I encourage you to look at, this one is using a U instead of an O. My handle is Barb Armstrong, CS for Charles Schwab. Cameron's is Cameron May, CS again for Charles Schwab. And they'll just change one letter. But if you look at the real me, I have posted, over 7,000 posts. And usually the imposters will have posted 50 or 60 or maybe 100, and they come in and they steal my images, and then they copy, a number of posts. And I just encourage you to, if you have one of those people reach out to you, take a screenshot and then just come to any post I've recently posted, like this one, and just hit reply. And then when you hit reply, you can put an image in and just paste that image in and let me know, and I'll get them shut down right away. But know that no coach will ever reach out to you with a Bitcoin deal, a crypto deal, private education for which there is a fee, or the scariest one that I've seen so far is saying like, hey, if you'd like to give me access to your accounts, I'll trade them on your behalf and split the profits. Not only is that illegal, and none of us coaches would ever do that, but these are all scammers. So just be careful. Okay, so and because I've had 6 of these in the last week, I thought it was important to mention it here today. So there's that. Just before we get into the topic of our topic for today, which is long verticals, know that options do carry a high level of risk. They're not suitable for all investors. If you want to trade options with Schwab, you have to apply for option trading privileges, and not all will qualify. And also know that we are using the Paper Money software application on the Thinkorswim desktop platform. It is a brilliant place to be able to learn not only how to use the Thinkorswim platform, but to make sure that you understand a trading strategy before you consider trading it in your live account, that you understand when you're going to place the trade, when you're going to exit the trade, and all those things, in addition to how to both place a trade and exit a trade on the platform. One of the nuances or differences, even though it looks like, smells like, feels like real money, one of the differences is that a short option will never be assigned early in Paper Money, and that can happen in a live account. If what I'm saying just sounded like Greek to you, don't worry about it. I'll explain it as we go. Okay? Yeah. So I'm going to do one quick announcement, and then we're going to talk about, for today, what is a long call vertical? What is it? Why might a trader or an investor consider using this strategy? We're going to outline the basics of what a long call vertical, some of the basics of things that you'll want to consider with long call verticals. We're going to discuss an example trading plan with potential. When might you want to enter a trade? When might you want to get out? How might you want to manage it in between getting in and getting out? And then we're going to place an example trade or two. So here's my announcement. We've got some upcoming workshops and market drives. So Santa Clara on October 12th is coming up quick. I will be at that event along with Ben Watson and a cast of others. This one, the registration is full. It is closed. Now, if you live close by and you showed up, you didn't hear it from me, but we'd probably find you a seat. But the registration for that is officially closed. So I tell you that because if you're thinking, oh, I live in Denver, I might go to that or I might not. This is a 2-day event. It's a 2-day class on technical analysis and an introduction to options taught by Ben Watson. He is absolutely fantastic. And if you're considering going, I'd say register sooner rather than later, because you don't want to end up, shut out. And the same for the event in New York. If you like theater, we're staying in the heart of Times Square. You're within probably a 5-minute walk of every, or maybe a 10-minute walk with the lights of every theater on Broadway. But more importantly, you'll get to meet, the rock stars, in the world of Schwab. And so if you can make that event, I'll be at that one also. Would love to see you there. Okay. So blank screen. Why am I doing that? Well, because I think this can be a confusing strategy when somebody first talks about it. And so I wanted to kind of draw it out, and then we'll go through the verbiage, and I think it will make much more sense. So let's say you have a stock that has been uptrending. So it's been going up, and then it pulls back for a few days, and it starts to go up again, and then maybe it pulls back for a few days. We call this pattern a bull flag. So here's the flagpole, and this is the flag kind of part of it. And then it starts to go up again, and you're saying, I think this is an uptrend. I think this is an uptrend. And so I would like to take advantage of that. And so what I'm going to do is I am going to come out here, and it's currently trading at, say, $52. So I am going to buy a call at 50. And maybe I'm just starting out and I want to manage my risk. So one of the ways I can do that is by coming up here and saying, and then in order to fund the buying of the call, I'm going to come up here and sell a call at 55. And let's say what this costs you is $2.50. Now, what's the most you can make on this trade is the difference between the strikes, or $5. So here's my potential max gain. is going to be $5 minus the $2.50. Or the most I can make on this is $2.50 a share. And each contract that I do this with represents 100 shares. So the most I can make is $250. How much can I lose? Well, I can lose the entire amount that I paid to place the trade. So the most I can lose here is $2.50 a share, or $250. But if I'm risking $250 to make $250, that's a 1-to-1 risk to reward ratio, right? Right. And yes, Maligator, I do have a bit of a cold, but I'm getting better every day. So, and this is called a long call vertical. Now, I don't want to confuse matters. Let me make this bigger. So it's called a long call vertical. Oops. But it could also be called a debit spread because we're paying to get in. And some people also will call this a bull call spread because we're bullish. What we're expecting is for the stock to continue to go up. Now, don't blame me. I didn't come up with this idea. Someone else did. But it's if somebody said, well, I thought we were talking about verticals today, and then somebody says this is a bull call spread. A bull call spread is a vertical type of trade. Now, for those of you that are new, what does it mean when I buy a call? Well, when I buy a call, it gives me the right to buy the stock at the strike price. So if I've bought a call at this $50 strike, I now have the right to buy the stock at any time between now and expiration. Let me just go over here. I can buy it at any time. And if things go according to plan, let's say it goes up to $60. Well, I have the right to buy it at 50. So I'm kind of doing the happy dance, right? Right. But just a minute. I also sold a call. Well, what does it mean again when I sell a call? Well, when I sell a call, I'm saying I am willing to sell you 100 shares of this stock for this company at $55 a share at any time between now and the expiration date. Well, just a minute. You're talking about buying a call. I don't even own the shares. Correct. You don't own the shares. So how can you sell something you don't own? Well, let's say it goes up to 60 and the person who sold you this call says, knock, knock, knock. Hey, Barb, I would like to exercise my right to buy 100 shares of this stock from you. And you are they call that being called out. I want to buy 100 shares of this stock at $55 a share. Well, what are you going to do if you're called out? Well, you are going to lickety split, come down here and exercise your right to buy. So you're going to buy 100 shares at 50, and then you're going to sell them at 55. So is this a bad thing? Is this a bad thing? No, you just got your max gain and you didn't even have to wait until expiration. So that can be, pretty cool beans. And you may say, like, this is awesome. Where has this strategy been all my life? Well, okay, just a minute. This is if everything goes swimmingly. What if instead of going up, what if it goes up for a few days and then ends up coming down? And we're getting close to expiration, and now it's trading at 45. What do you think is going to happen to the value of this? It's going to become worth less and ultimately worth nothing if you get to expiration and it's trading below this 50. Okay, so we could lose all of it. This is this max loss. We could lose 100%, and we could also make 100%. Now, is our goal to make 100%? That used to be my goal. You know how often I made that? Almost never. And so we might say we could make up to 250, but how about if our goal was to make, our goal could be to make 50%. Say, hey, if I could make 50% on a trade I'm in often for less than a month, I'd be pretty happy. Or maybe my goal could be 25%. You know, you can make your goal whatever you want, you know, when you create an example trading plan. And so that's how that works out. Now, there is door number 3. What is door number 3? Well, what if it ends up, and I'm going to stay with black here. What if it comes down, it goes all the way up here, and then it comes down, and you're getting close to expiration, or let's say you're at expiration, and it closes in between the strikes. Well, if it closes in between the strikes, it's very highly likely that you will, because this is in the money, you will have bought 100 shares of this stock. Okay. So what do? Well, what if you have a small account and you only have, say, a $3,000 account, and you've agreed to buy 100 shares at 50, so that's 5,000. Well, if this expires on a Friday, come Monday, you're going to be getting a call from your broker saying, excuse me, Barb, yeah, you don't have enough money to buy these shares that have been assigned to you because they were in the money. So you need to deposit more money into your account. Now, what you could do if you don't have the money is lickety split on Monday, sell them. And if it's still trading above 50, let's say on Monday, you know, it's trading at 52, well, you still made $2 a share. So you're a happy camper. You lost a little bit, you know, you were down $50, but but you still did it, you know, it wasn't devastating. But what if news comes out on this company and on Monday it opens at 45? And you have to sell at 45, but you bought it at 50. Well, now you're down $5 a share or 500, you know, which is not a happy occasion. Tears of sadness. You know, but it's like, hey, I thought you said the max loss was 250. And I did. This is our theoretical max loss. But if you let it go into expiration and it closes in between the strikes, you can end up losing more than that. And so this is why some people, as part of their trading plan, will have a rule that says, you know what? I'm not going to ever let this go into expiration. I don't think it's going to close in between the strikes, but there are never any guarantees. Yeah. So because the 50, well, at expiration, if it's in the money, it is, you know, your odds are very, very high of it being exercised. Even if it's in the penny, even if it's in the money by just a penny. Okay. Now, if you call your broker immediately, you know, you've got this sold call, but if it's not, like, this would have expired worthless, the sold call, because it's not in the money. Okay. So are there any questions? The 50 call, if it's in the money, will be exercised, and the sold call, the short call, will expire worthless. If it closes at 45 or somewhere below 50, they would both expire. They would both expire worthless. Okay. So I don't want to get into the weeds on this. If you're interested in this strategy, and I think it can be an interesting strategy, there's a whole class on Thursdays dedicated to it that is taught by Ben Watson. And so you can spend 45 minutes a week just on long verticals and diagonals. And so now let's get into the verbiage, and I think this will make more sense. Okay. So, Jay, I like the way you're thinking, and I'll come back to that question in a minute. He's saying, can you put a stop, you know, order in place to kind of manage the damage potentially? So how do we create this? Well, we've already talked about this. We're going to buy a call, and then we're going to sell a less expensive call above it with the same expiration. And, if there's a net debit, there's a cost to get in. And that call, when we buy a call, it gives us the right to buy the stock. And then when we sell a call, it obligates us to sell at any time up until the expiration. And this is a bullish strategy because we're expecting the stock to go through both of those strikes. Now, you can trade this in a more bullish way or in a less bullish way. What do I mean by that? We'll talk about that when we look at our examples. Okay, so what are some of the benefits? Well, one, they call this speculation, but it's like if we're looking at the charts and we look at this and we say, hey, we just want to be able to benefit from a bullish stock that is moving up. And if we have a small account, we may not be able to buy very many shares. So this is a way for us to benefit. It allows a trader to potentially participate in the bullish trends of higher price stocks that we couldn't afford to trade otherwise. I like to say that are out of our snack bracket. But by both buying and selling a call at the same time, we are limiting our gain to the strike price minus what we paid to get in. So the difference between the strike prices minus the debit paid. And this tends to be a shorter to more intermediate term. Often people will look at something in this kind of 20 to 50 day time frame. We've got to take transaction fees into account. Our risk increases with the number of contracts that we trade. Our max risk is defined. So, unless you let it go into expiration and it closes in between, and we've already discussed that, but our max risk is defined, and a lot of people find that to be very helpful in managing their risk. Okay, and again, we talked about the fact that a short option can be assigned at any time. And this doesn't necessarily have to be a bad thing, but it is a thing, and we need to be aware of, if it happens, how are we going to handle it? And so we've discussed how we might handle it. We could end up owning the stock at expiration if it closes in between the strikes. And then what's our plan if that were to happen? And we've discussed that as well. So we've actually covered a lot already. Oh, let me just get rid of my drawing tool. Okay. So I'm a big fan of trading plans, and I've actually created a trading plan for this strategy, and I'll show you where you can access that in a minute. But a basic trading plan is going to have 4 components. It's going to have in this case, what to buy, when to buy it, how much to buy, and then when to exit. Okay. So this is kind of the what to buy piece of it. So what are we looking for? When we're out there on the Thinkorswim platform looking for a candidate, well, one, we're looking for stocks that trade 1 million shares a day or more. And you might say, okay, isn't this an options class? So why do we care about the stock? Well, we want stocks that are trading high volumes, because if the stock is trading high volumes, and if we say, well, let's make this 1 million shares a day plus, you might want to make it 5 million. You might not want to have that as a parameter at all. But if that's heavily traded, chances are the option is going to have higher trading volumes. And that's expressed as open interest, which is the number of contracts that were on the books when the market opened, and volume, which is the number of contracts that were traded today for that stock, for that expiration date, for that particular strike price. And then, of course, we want it to be uptrending or in a sideways trend. That might work as well. And I'll explain that in a second. And then for options, we also want the bid-ask spread to be tight. And you might say here for trading volumes, you might say 20 times. Now, I know some coaches even may not even have this open interest on their option chain because they might say, hey, if the bid-ask spread is pennies apart, I can assume that the trading volume is going to be sufficient. And others say, well, I want to be able to check that box, so I'm going to put it on my option chain. And then for bid-ask spread, the market maker makes the difference between the bid and the ask. And so if there's lots of people trading that particular stock at that particular strike, they might be willing to take less because it's easier to match up the buyers and sellers. And you might say, well, if this is a $10 option, I'd like it to be less than $1 between the bid and the ask. Okay. Now, what about, so this is the what to buy. What about the when to buy? So when we're looking at when, and I'm just going to draw this out because I've already done it actually. So here's our, uptrend. So this is a bull flag. And what we're looking for is a move or a close above the high of the low day. Some people will call this a hold. So when it's kind of pulled back and then it starts moving again, we want to see a close above the high of the low day and might consider that an entry. Now, what if something's been going sideways for a while? So some might say, well, if it's been going sideways, I could see when it bounces off a support level, maybe I could do my vertical here. And then if it comes back up here, then I'll buy it back or I'll sell it and I'll close it out. Now, what if it continues to go sideways and then it breaks out and it comes back maybe and retests and then goes up? So, if it breaks out above resistance, you could say, well, this might be a time to enter. This might be a time to enter. This might be a time to enter. And if you watch Cameron May does a Getting Started with Technical Analysis class where he covers the absolute basics, things like trend, support and resistance, basic technical patterns. We've seen a lot of this type of consolidation pattern lately where something kind of came down and came up to a ceiling or a resistance level and came down again. We call that a cup and a handle kind of pattern. And then it breaks out and comes back. So this is another kind of slightly different pattern. But, or if you add another cup here, it now becomes an inverted head and shoulders pattern. And if it breaks out. So these aren't the only ones, but this is a few examples of bullish potential entries. And this is a bullish strategy. Okay. Now let's go out to the platform now that we've looked at all of that. And let's look at something live, because to me, this is kind of the purpose of a webcast, is to kind of take this theory we've been talking about. And if you've done the course, you can see. Now, one thing I want to do, and I don't normally do that in this class, I'm going to come to sector indices. And we don't usually look at what's happening in the market, but the market last week, if we looked at the S&P 500, it was hitting an all-time, it hit a new all-time high just a couple of days ago. That was last Thursday. But we can see in the last 3 months, which sector has been strongest. It's been the utilities sector. And if I click on utilities, I have the watch list linked to my chart. It's hitting a new all-time high today. And over the last 4 weeks, which sector has been the strongest? Utilities. And so if you're just starting out and you're saying like, where might I look for stocks? Maybe we want to look at a sector that has been really strong. And I'm only saying this because one of the examples we're going to look at is CEG. Okay. I can do this. CEG. And if you're not familiar with Constellation Energy, you may say, isn't that an energy stock? And the energy stocks, are vying with healthcare for last place in the last month. And if you click on the Analyze tab, it'll tell you what sector this company is part of, and it's a utility. So excuse me. So this is an electrical company, actually. Okay. So if we look at this and say, well, it's in a strong sector, some news must have come out because this thing gapped up. And sometimes when things gap up, they'll come back down again. But that didn't happen with Constellation Energy. And this is a stock year to date up 123%. Like, you might say, well, didn't we miss the opportunity? But what if we looked at this and said, it's sitting at 260. Let's come out and see, are there even options traded on it? And could we do something 255, 260, 260, 265? Just a week ago, it was up here at 271. Back a few days ago, it hit 262. It hit 270. Here it hit 267. So could we come to the trade tab? And this does have both weeklies and monthlies. When is earnings coming up? So if we come to this blue dot, we can see earnings is November 11th. And if you want to trade something conservatively, you might say, well, I would prefer to be out of this before earnings. So that means if I come to the 15th, it's not that I can't place the trade, but I want to be sure I'm out of it before the 11th. So, and this one has only $10 wide spreads. Now we've got hundreds of contracts here. Now this particular account has $1 million in it, but if you're just starting out, you might say, well, it may have $1 million in it, but I don't want to risk more than $1,000 on any one trade. So if we came to this 260 and are trading a smaller account, we don't want to risk more than 500. So here we're paying $445 for this, but it's sitting at 260. It has to go up by $10 for us to hit our max gain, but it has 45 days to do that. So we could do that. How about if we went 250 to 260? So that would mean, so this is more aggressive, right? Because it has to go up by $10 a share. I wonder how much we'd have to pay if we did 250 to 260, and it's already through both strikes. Well, here we're paying $5.15 or $515. So we could even put that in our trading a smaller account class because it would meet our max risk parameter. And then we might say, hey, if this gets up to the point where it's worth 50% more, so that's 540 times 1.5. When this is worth $8, I would like to exit this position. Now, how much could we lose? When we come to our confirmation tab, we could lose the entire amount we're paying to get in. The most we can make is $465. But if we're saying like, we're happy with about half of that, we'd be cool with half of that, then we could go ahead and put that trade in. And how many contracts are we going to do? We would do one because, we don't want to lose more than $540 if we're doing this in our smaller account. So if I come back to edit, now here's our smaller account, and our rule here is we don't want to risk more than $500. Now remember our guideline. Our guideline was, does this trade more than 1 million shares a day? Check. It does. We're already at 1,500,000 or close to it. Does it have, this is open interest, number of contracts on the books when the market opened today. We have hundreds of contracts. We said our guideline was 20. Is there less than a 10% difference between the bid and the ask? So, this is over $20 a share. So, we're 70 cents apart, and we're saying, hey, we could be $2.30 apart. So it meets that parameter as well. Now, some might say, why not just buy a call? Well, if we bought this call, either one of these calls, $1,790, if we don't want to risk more than $500, we couldn't afford to buy a call. And at $250, it's currently $260 a share, we couldn't afford to buy very many shares either. And so this is a way that we could trade this more expensive stock, without, and managing our risk at the same time. Now, what we're going to do is we're going to put in a target. So we're going to come down to advanced order, single order. We're going to make it a first trigger sequence. We're going to right click, create an opposite order. It's currently at 540 times 1.5. So when it gets to 810, that's a 50% gain. We would like to take our money off the table. Or what we'd like to do is take our risk off the table and close it out. Because what the market giveth, the market can taketh away. And if in a week we were up by 25%, might we say, you know what? We just made a 25% return in a week. I'm happy with that. Especially if it looks like the stock may start pulling back. And so, we could choose to exit. Just because we put in a 50% target. Now, our guideline is if it goes down by 50%, we want to exit also. And we're just going to look at that daily and see where it stands. So why not put in an OCO order? Because sometimes when the market first opens, there can be a lot of volatility and the bid-ask spreads can be wider. And if you get nicked out for a 50% gain, we're okay with that. But we don't want to get nicked out for a 50% or sometimes even a greater loss, because there's no guarantee that you get out with just a 50% loss. We'd rather, wait for the market to settle down. And so that's why, because I've seen this happen in a live account where, it hit that exit, got out for much greater than a 50% loss, and then the volatility in the market settled down and we wouldn't have ended up out at all. And so, this isn't, it's practicing, but it's practicing for life if you actually decide that you're going to trade this strategy. So would you guys like to see another example? So here so this is kind of a more conservative way, because where are our strikes? And I'm going to come in to a 3-month. So we're kind of in up close and personal, so that when I draw my line here, one for 250 and one for 260, I can just draw kind of roughly where I want it to be. And then if I want to show this on the chart, I can say, here's my long call vertical, 250, 260, and it expires November 18th. But we want to get out by November 11th. So it's already, as long as it stays here above 260, we should be good to go. But if it falls, we've managed our risk. And we know that as long as we exit before, this is 250, exit before the expiration date, we should be okay. And in fact, we have earnings here, November, scheduled tentatively for the 11th. So we'll want to be out before the 11th. Okay. So let's look at another example, EXC. And again, here's another stock. This one is up far less, 13.5% year to date. If we come and we look at the chart, we can see it was kind of going a whole lot of sideways, wasn't it? Some might kind of draw lines here and say we had this big double bottom or cup and handle type pattern, but it started to come up. And if you look at this as your cup and handle, then it broke out, came back and retested. Do you guys see that? And has taken off again. And so this one is much less expensive, but we have earnings coming up on the 30th. So we might want to do something closer, to the shorter end of the time frame, here October 18th, and maybe we do, the 40, 41. So I'm going to let you guys work through this because our class is kind of coming to an end. But we can look for these types of setups if you wanted to practice. You could look at something like Pinduoduo, which, I went and looked at the news on this, and even though some have dropped after, the news, it beat on earnings, but they may have dropped their targets for this, but it was still like 185, 175 kind of, so way up above this line here. And so, might we consider something there? Or if you wanted a less kind of Tums promoting chart, something like Walmart, which is up 54% so far this year. And, it's just been kind of marching up the hill, hasn't it? And could we expect to continue to march and take advantage of that uphill march? And again, might you look at this and what kind of pattern might you be seeing? We might be seeing a bit of a mess on my chart, but could this be a bull flag? And do we have that hold? We do. Because our low was Friday and it went up above that, and we've been seeing it bull flagging along. So you might say, well, I have my entry now, has it traded more than 1 million shares? And go through the rest of the exercise. Now, I wanted to show you a couple of quick things just as we're wrapping up. So I'm going to bring you it, and here in the bottom right corner, there is a tab. And, whoops. So, yeah, we're going to come to Trader Talk. So you're going to want to hit the subscribe button. And what that will bring you to, when you subscribe is, and it's complimentary, but when you first get to this page, it will show what's now playing. And then if you come to playlists, if you want to do some binge learning on options, you can come down here to the very bottom and choose getting started with options. And you can see, and we have them listed, so from 1 through 12, and then we just start over again. But you also have access to all of these other classes. And one of them is a playlist called Trade Management Mini Sessions. And in there, I am collecting or creating some example trading plans. And this one is for long call verticals, which is our strategy today. It's 17 minutes long. I'll put a link into this at the end of the class. So if you go to the archive and actually, whoops, sorry. Okay, let me just mute me and I will put this in here. Okay, so there's the link, and it will also be in the show notes down below if you're watching this in the archives. Okay, and then if you're new to Schwab and you want some quick and dirty, how do you set up your chart like that, or how did you set up your watch list like that? All these ones in turquoise are just, they tend to be shorter. Like this one is 8 minutes long, 7 minutes on how to use notes, but how to customize a chart or a watch list or the monitor tab, all of that. Okay, so these are in turquoise at the bottom on the trade management mini session link. So you please hit like if you haven't done so already. What like does is it helps move things up in the algorithms. It also lets Cameron and I know that you found this content valuable. So as Cameron May likes to say, it sounds like applause to us. There's also a survey link that Cameron has just reposted in the chat. And this survey, it's 2 questions. And you pick from 1 to 10. 1 was, I hated it, I'm never coming back. 10 was, I loved it, I'm never going to miss another one, and everything in between. You can also put comments in. So if there are things that you would like me to discuss in upcoming classes, Let me know. Let me know if you like the pace. I promise if you fill it out, I'll read each and every comment. So to just wrap up today, we looked at what a long call vertical is. We looked at some of the important considerations, some of the numbers. We looked at or kind of walked through some of the basics of an example trading plan. We looked at how you might choose a stock that you might want to consider placing this type of trade on. And then we followed the steps and we placed an example trade. So if you want to see that followed up on, I do teach trading a smaller account on Mondays and Fridays, and we'll follow up on it within the context of that class. So thank you so much for joining me today. Thanks to Cam for being in the chat. Thanks to the guys behind the scenes. And most importantly, thanks to each and every one of you. Don't forget to follow us in the land of Twitter and make sure, that you're getting the real thing. Cameron May CS and at Barbara Armstrong CS. Up next is Trading Flag Patterns with Mr. Ben Watson. I hope you'll stay tuned for that. Take care, everyone. Bye for now.